If you're looking to do a startup and you're not able to get financing, there's usually a couple of reasons. One, unfortunately, if that doctor had, say, a recent bankruptcy. Other pieces would be liquidity. Cash always has been and always will be king. There's kind of an old joke that if you need money, you can't get it, but if you don't need it, you can get as much of it as you want, right?
Hey everybody, and welcome to another episode of the GrowOrtho Podcast. We're filming this one at our headquarters here in Pensacola, Florida. We got a great episode for you guys today, talking all on practice loans, financing, and making sure you have the capital resources to set the practice up for success. John, so good to have you in Pensacola. Thanks for coming to the office. And
Very glad to be here.
Welcome to our awesome media studio, and welcome to the GrowOrtho Podcast. So glad you could join us.
My pleasure.
Why don't we just kind of start off? Tell us a little bit about yourself, who you are, where you're from, what company you're with, and let's just kind of dive in that way.
John Shaw, the company that I work with is Provide. We specialize in healthcare financing. A big portion of that is dental, which is our relationship with kicking off this podcast. I've been in the healthcare lending space, predominantly dental, for well over a decade. And I've been with Provide for about 5 years. Prior to that, I spent 10 years with another dental lender. And I live here in Florida as well, Santa Rosa Beach, which is about an hour and a half away from here. I cover Florida for my territory, but we're a national dental lender, so we service the entire country. We have people like myself in some states like Florida. There's two of us. I have a counterpart. We do everything together because Florida is such a big market. And then some other territories, there might be one rep who covers 2 or 3 states, depending on the demographics. Lead that a lot. I'm a father of a 16-year-old daughter who is going into or just started her junior year.
Nice.
We were originally from Ohio. We came down to Florida about 4 years ago, and it's been, you can go as deep as you want into that. But having a 16-year-old daughter in a job that is fantastically demanding. Yes, getting away from the weather was a big driver. That was those cold winters, and you wake up in the morning and you see 2 feet of snow. When you're young, right, and you're a kid, and you get to go out and play and build snowmen and snow forts, great time. As you get older and you step outside and you feel your joints stiffen up a little bit, that's a game changer. Yeah. So I absolutely love it down here in Florida.
Yeah. I was born and raised in Northern California. Beautiful up there. Somehow I ended up in Chicago for college, and I was playing lacrosse there, and we started our practices in December. So here I am, this unassuming California kid, go out for my first lacrosse practice in December. And within 30 seconds, I said, I think I've made an error.
Yeah.
It was it's 10 degrees below zero.
Quick.
Yeah. Yeah. So I ended up not finishing out college. I came to Florida, and the rest is history.
Beautiful area. We were talking a little bit before the podcast how, there's a ton of opportunity for dentists here because just like all of Florida, we keep on growing and growing and growing. And I don't know how the Panhandle stays such a secret, but it's beautiful, right?
Let's keep it that way. Never come to the Panhandle.
Yeah, right. Stay away. We can't handle the traffic.
Yeah.
But you have just beautiful scenery, right? Everything is being built out. You have a lot of new places, but then you go to downtown Pensacola, which the first time I went down there, I remember same conversation we're having right now. I'm like, how did I not know about this? Yeah. Right? Like the way they've redeveloped downtown Florida and kept it in that original, Pensacola, and they've kept that original, you walk in and you see the brick floors and gorgeous.
Yeah, super cool. Well, obviously, with what we do at HIP, helping people get new patients in and marketing, obviously financing's a big deal, especially for startups, especially for first-time practice owners, but that obviously goes into established owners and expansion. But we just started hearing about Provide probably a couple years ago. I didn't know anything about you guys. Mm-hmm. Your counterpart out in Atlanta, Jacob Fenno, I think he just clicked on one of our ads, and we got on a call, and the light bulb went off for us. How have we not gotten to know these people? But let's kind of talk about like first-time owners and or startups for a moment. You know, it's probably one of the first things people are doing is getting their financing in order along with real estate. And there's a lot of options. So why don't you talk to us a little bit, like what's the big difference between like working with Provide and like traditional financing? Yes. Like the big ones I hear, like Bank of America and Wells Fargo. Tell us about Provide. How is it different?
Let's start a little bit on where Provide came from, because I think that story helps show why we've been able to be different than traditional banking.
Yeah.
Provide started, it was actually called Lendeavor. It was a startup that was funded or financed by fintech, private equity.
Okay.
Right. So that was about 8-9 years ago.
Okay.
It was a little baby, brand new, but they had developed a technology that was financial tech, fintech. Mm-hmm. And this private equity group saw that fintech and said, well, you know, in the business lending in general, there's really not fintech lending, right? It's in home lending and student loan financing and et cetera, but it really hadn't been in business lending. And then having a niche in dental lending made it even more appealing. It didn't come from the same hands that bank financing comes from.
Interesting.
In bank financing, there's these sort of unwritten rules of, well, this is the way we do it. And you may be in those positions where you say, well, why do we do it this way? And basically, to summarize it, the answer would be, well, that's the way it is, right? Not a lot of dialogue, really just, it's not broken in their eyes, so don't fix it. So with Provide, because it came from private equity money, they were able to start by doing different product offerings and different sets of rules, if you will, or we'll call them tool gates, right? So some example of tool gates would be, hey, doc, if you want $1 million loan, you need to look like this, you need this type of cash, the practice needs to have this type of revenue, et cetera. And what Lendeavor and now Provide was able to do, because we came from a different beginning, we always go back to our logic and reason. If it's logical and it's reasonable, we should do it, right? So to throw out a caveat, we're very responsible, right? We're not just, oh, doc, you want $2 million to buy $1 million office? Here you go. Doc, you want $2 million, and we're not going to put a doctor in a position to fail, right? So we're still very diligent. And so with that growth, we went very quickly. I joined the company 5 years ago. Okay. And in my first year at the company, I think we did slightly under $1 million in dental financing. Fast forward to today, 5 years later, and technically my third year at the company, we were doing over $1 billion in dental financing. That type of growth in the banking industry is very rare, right? To just come into, yes, right? So you have to be doing something different, right? And what we did is we listened to what the market was asking for, what doctors needed, and we delivered time and time again. And we've had an incredibly strong portfolio all along the way because we do our financial analysis at a very high level. So if you're looking to go into your in-depth question, if you're looking to do a startup, what we do differently in that world is we've continued to raise the bar. So what happened a few years ago is banks had a cap on how much money you could get for a startup. Yeah. And that cap, at one point years ago, that cap was $450,000. Fast forward to today, and you can't even doing a startup for $450,000 is near impossible unless you were able to get lucky and find that needle in a haystack where there's a dental office that used to be a dental or that is no longer operating. Yeah. And you don't really need to do any construction work. You just maybe need to do some minor upgrades and equipment. But that's not the true startup, right? It was at $450 back then. Nowadays, it is very common to go to $800,000, right? Nearly doubled in a short period of time. Just a few years ago, that cap was $650. Now, what would end up happening is a doctor would say, hey, I have an incredible background as a doctor. I'm producing, $1 million, $1.5 million a year in production. I'm earning $300,000, $400,000, $500,000 a year. I have hundreds of thousands of dollars in cash. I need an $800,000 loan in order to properly build out my space, get all the equipment I need, and have enough operatories ready to go, have my working capital so I can market and advertising and get consulting. And banks it was just a flat no, right? But the problem is contracting costs have gone up big time since COVID, right? Equipment costs have increased. Everything's gone up. And so we needed to raise the bar at Provide. And we took it from $650 to $700 to $750 to $800. Now we have, for select doctors, $1 million for a first-time startup.
Wow.
Right, which is just, again, completely unprecedented. So we've led the way. And the positive part about that for the doctors is the other banks, like any good business would do, the other banks have also made adjustments, right? So it's been a benefit to the marketplace as a whole. So now other banks are also saying, well, we can either do no startup loans or we need to do what doctors need, which is increase how much money we'll give them. So now you do have more banks that are going to that 7, that 750, that 800. So that's been a win for the community as a whole.
It's awesome. What are those flaws that you see most startups or first-time practice owners run into when they're looking for their financing?
When they're looking for the financing?
Or when they get it.
Okay. So
or.
Let's go both.
Both ends
Great
of
questions.
the coin.
If you're looking to do a startup and you're not able to get financing, there's usually a couple of reasons. One, unfortunately, if that doctor had, say, a recent bankruptcy, and context is everything. So we have doctors who have gone through bankruptcies. They've reestablished their credit and their personal financial statement. So that's not an automatic no, right? There's still light at the end of the tunnel. Unfortunately, we're talking about borrowing money, though. And a big piece of borrowing money is banks look at, hey, how have you managed money in the past? So we can get through a startup or through a bankruptcy, but if someone is filed for a bankruptcy, say a year ago, it's going to be very difficult to get financing. Other pieces would be liquidity. Cash always has been and always will be king, right? There's kind of an old joke that if you need money, you can't get it, but if you don't need it, you can get as much of it as you want, right? And so cash is king. Now, you don't have to have a ton of it, but you do need to have some of it. And there's logic and reason behind that, right? If you don't get off to as quick of a start as you had hoped, and you kind of burn through your working capital while growing your practice, or you open your doors and there's a natural disaster and you have to close your doors for a month or two right after you open your doors. There's things that are outside of our control. And so that extra cash that you have, that's a safety net. And it also goes to show a little bit of a track record on how a person manages their money, right? If you're making, as an associate, if you're making a few $100,000 a year and you haven't been able to put any money into savings yet, unfortunately, a credit analyst is going to look at that and say, well, what are the spending habits? And are they going to continue to not put money away even if they're making money? And the it's not knocking. Everybody's different, right? It's not judging people. It's simply that the credit analyst's job is to look at a deal and say, hey, what type of risk are we taking on? And so if you have a successful practice that you've built, maybe you financed it yourself. Maybe you were able to get a loan from family or friends. And you can have a very successful office that you did build from scratch. But if you're not putting money away and something happens, that can topple that business overnight, right? Again, natural disaster or many things that can happen in life. If you end up, if you have $1 million practice, but you don't have any cash in the bank and you have to close your door for a couple of months, you don't have that reserves in place to take care of all your bills and float through and get through whatever that difficult time may be. So cash would be a reason where people are not able to get financing as well.
What does that look like for me? Let's say I'm right out of residency, not working as an associateship, and I want to do my own business right off the jump.
Are you saying right out of residency, not associating yet?
I'm right out of residency. I'm not associating yet.
Do you have cash or you don't have any cash?
I'm a broke college student. I'm coming out with $500 to $700K of school debt.
Which is very true.
You know, I talked to somebody came out almost $1 million in debt, but it's rare that I see somebody that's coming right out of residency, not taking an associateship and jumping right in. But I took a call with somebody. I actually referred him to you guys, and he's looking to do a de novo right out of school, not take an associateship. How does that work? Yeah. Is it even possible for me to get financed?
That is a conversation that I have almost every day with a doctor. When I'm talking to them for the first time, there's plenty of doctors who are getting out of a residency, and they're like, I want to start a business. And I have to be, whether the bad guy or the honest guy or whatever you want to call it, I have to explain to them, well, here's what we need to do to get there. It's not that the answer is no. We just need to do what we need to do to get there, and here's what we need to do. So if you're just coming out of residency, you have $5,000 in the bank, and you're not going to take an associate position, it is, I don't want to say impossible, because you never know when somebody may pull a rabbit out of a hat, right? A small local bank sometimes can be great at looking at an application and saying, all right, let's do it, right? Small local banks, you have your middle market banks or mid-sized banks, and then you have your extra large banks like your Wells Fargos, your Bank of Americas, your Chase. They have different appetites, and they also have different regulations, right? Your big banks have many, many more regulations, whereas the local banks, they're able to kind of lend off of their portfolio. And if they have somebody that they believe in, and they say, hey, let's go ahead and do this practice, you're an ortho, we know and believe you're going to kill it. Yes, here's $800,000 or whatever that number may be. In general, though, and maybe let's step back here and talk about financing across the board on a broader level.
Let's do it.
What I would say is you have a handful of dental-specific lenders, right? You have Bank of America, you have Wells Fargo, you have Huntington, you have PNC, you have Provide, my company, and I would always make sure you're at least speaking to a dental lender.
Okay.
If you want to compare them to another local bank, by all means, do what you feel comfortable with doing. But what dental lenders are able to do is they're able to tailor the loan to help set you up for success. You're also going to be working with people like myself and the credit analyst who only look at dental loans. So you're going to have a streamlined process getting through. Now, we can continue, and we will continue to talk about what sets Provide apart from the other dental lenders. But the interesting part of this conversation is you have this dental niche of lending, and there's those anomalies that can happen outside of the dental niches where you might find a small local bank who will say, well, I know nobody else is doing this deal, but we like this deal. And they have that luxury of not being bound in the same way as banking regulations with the bigger banks like us.
Yeah.
So that's why whenever a question that you asked about, first you're just getting out of residency, don't have any cash, don't want to get an associateship, I can tell you 99% probability what's going to happen.
Yeah.
But then there's those anomalies out there that can
tough.
also happen. Mm-hmm.
So if I'm coming out of school, I know I want to start my own practice, start my own business very quickly, whether it's right out of school or in a year, 2, 3 years, there is a lot of advantage to taking even 1 or 2 days of an associate gig in terms of getting financed. And also it sounds like how I go about my spending habits once I actually get a salary are going to have long-term dividends or effects
100%.
On my financing. Because I see this happen too, Been in school for 10 years. I haven't made any money. I get a sweet associate gig, and I've seen some DSOs offering people $400 to $500K right out of school. Let's say I come right out of school. I think Grant Cardone said like the $300,000 salary is the most dangerous salary that you can be in, because you can pretty much buy what you want to buy, but you're also not making 7 figures where you're putting away as much as you're earning. So to young doctors that are listening, don't go buy the Mercedes-Benz as soon as you get your $300,000 salary, which can be difficult.
Oh, yeah.
I'm used to living on nothing. Now I'm making 20, 30, 40, 50K a month. The world seems endless, but if you want to do your own business, it sounds like spending habits and saving habits are going to have effects on my lending.
That is 100% accurate.
I didn't know that. That's huge.
Yep, 100% accurate. So this is why podcasts like this, this is why I go to dental schools around Florida and talk to the D4s. This is why we do seminars and so on. But many doctors will slip through the cracks and not get this message. When I go to a dental school, one of the first questions that I ask them is who wants to get into ownership? And if you have a good amount who want to get into ownership, one of the very next things I tell them is you have to decide how important is ownership to you. If you say, I don't want to be an owner, I'm never going to be an owner, your financial advisor will probably tell you don't do this anyways. But if you don't want to be an owner, then if you want to go buy a house that's going to have a big impact to your monthly cash flow, if you want to go buy a car that's also going to have a big impact to your monthly cash flow, well, you don't have future plans for that cash. So feel free to do what you want. If you're telling me you want to own a practice, patience, right? One step back so that you can go 2 steps forward. Don't go and buy the nice house. Don't go buy the nice car. And like you just mentioned, the temptation is there. You spent all these years, right, eating noodles and, everybody else, all your friends from high school, they've been out of college for several years, and you see they bought a house, they bought the car, and you may want to show them, well, this is the fruits of my labor. Be patient, right? Because the fruits of your labor are going to magnify and jump 5x, 10x if you get into ownership, right? You're going to have that ceiling, whether, like you said, 300, 400, 500,000. Well, that ceiling is going to be there, right? There's only so many patients you can see in a day, in a month, in a year.
Right.
And you're being paid off of your collections. Well, if you get into ownership, and you have a dental office or 2 dental offices or 3 or 4 or 5, that amount of wealth that you're now accruing is substantially larger than you're ever going to be able to do in an associate position. So if you take your time and you can buy a house, right? Quick side note, as a dentist, you get dental home loans. You can get 100% financing without any PMI insurance. So you can still go buy a home, right?
I didn't know that.
Yeah, you can, and we can talk about that a little bit more, but you can go buy that house, right? Just buy something nice. Don't drain your cash, but make that payment to where when you go to get a practice loan, that payment is not going to be siphoning out the cash flow that you're buying or going to get when you start an office. And also, very important side note, that payment, that monthly payment on a home loan is even more drastic in a negative way when you're doing a startup. Because on a startup, it's all based off of projections. And in year one, banks aren't projecting that you're going to make $1.5 million in collections, right? They're going to say, hey, we think you're going to make 300, 400, 500,000. They're going to be conservative, right? I know with HIP, you have people blowing those numbers out of the water, like the 3, 4, 500 is you're blowing that out of the water, but the banks aren't going to assume that.
Right. They're going to assume conservative.
So if you keep those monthly expenses low, get the practice, grow the practice, get the cash flow to where you're able to easily take on that home, right? And if you were to tell me, if a doctor is to tell me, hey, I want to have 3, 4, 5 locations. My conversation with that doctor is, okay, well, we're going to get this first location. And when you hit a home run there, it's too early to buy that dream house. It's too early to buy that dream car, right? Keep your eye on the prize, long-term planning. And that is going to catapult you so much further ahead than if you go buy that house. You're basically stagnating your growth potential.
That's huge.
Absolutely. So going from the startup, right, when you get the financing in place, we're going to need to have basically we're going to need to take into consideration your home payment, your car payment. Student loans aren't a problem. If you have $500,000, $600,000, $700,000 in student loans, that's not doc, you have too much in student loans.
Okay.
Right? There's the SAVE plan out there, right? The student loan SAVE program, which is going to keep your monthly payment low. And we're going to use that minimum monthly payment, so that's not going to kill your cash flow.
The biggest value I got that I think the audience is going to love here is how you go about bringing in money and saving money when you come out of school. If you want to own your own practice, the decisions you make in those first 1 to 3 to 4 years out of school, it's going to have a big impact on how much money you can get.
That's exactly right.
It's tremendous.
And so that was part of what you were mentioning in your question previously. You mentioned associating, right?
Yes.
Associateships.
Yep.
One of the keys to a successful startup is you need to have an associate position while you are building your office.
Huge.
Right? Like the movie Field of Dreams, great movie, right? If you build it, they will come. But remember, he built it and he struggled for a while. Right? He didn't just build it and it was full. He was, if I remember correctly, the farm was about to go bankrupt.
Yep.
And people were looking at him like he was crazy. When you do a startup, you may hit a home run, and that's awesome, right? Amazing. When you open your doors, having 2 to 3 days of an associate income, it's going to make your life less stressful, right? You're not going to have to change your lifestyle. If you are married, if you have children, that's going to make the household less stressful because you're not going to be looking around saying, I was at the office 4 days this week and we're not even breaking even.
Yeah.
Don't put yourself in that position. And the banks aren't going to let you put yourself in that position. The banks are going to say, hey, you need to have this associateship. Now, the bank is not going to say, hey, you need to have this for 2 years. The bank is going to trust you and give you the autonomy to know that, hey, doc, when you get to the point where you only need to associate 1 day a week, that's fantastic. Go down to 1 day a week.
Cool.
Right? Because you're going to be making more money in your own office. And when you get to the point where you have your patient base and your appointments booked out, 6 weeks, and you say, it makes no sense for me to associate anymore, stop that. We want you in that office. We just want to be pragmatic about it, right? So whether that, if you hit a home run, right, and HIP gets you up to that point where 2 months in, you don't need to associate anymore, great. But there's startups, you may need to associate for a year or a year and a half. Part of that is demographics. Part of that is your location. What state are you in? What part of that state are you in? And it's not a failure because you had to associate longer than somebody else.
Right.
There's no guarantee on how long it's going to take. So let's be pragmatic. Let's be financially responsible and know that, yes, I am going to have to associate for an unknown period of time, and that's okay.
Yeah. I say most of our successful startups have associate gigs when they get open. I do know one startup, and that was actually part of their loan deal, is they required him to work 1 or 2 days a week as an associate until collections got to a certain point or something like that. But, what are, to shift gears a moment, outside of just startups, what are the big variables to look at from lender to lender? I think the big ones are, my interest rate and how much money can I get approved for? Is there a big spectrum of sway from lender to lender in interest rates? Is there a big sway in how much money I get approved for? So let's talk on that. And also, what are the other variables that maybe the uneducated consumer or new to this maybe aren't looking for?
So let's simplify it for our audience. Let's assume we're talking to the main dental lenders.
Yep.
Right. So within the main dental lenders, for the most part, interest rates are going to be in the same ballpark. Now, you can magnify a moment in time where there could be a lot of variance. We've been in an interesting economy, and we've been in an interesting rate environment for kind of since COVID. Yeah. Right. So if you were to take these last couple of years, you'd see rates go up, you'd see them come back down, you'd see them go up. They're actually on the way back down right now, and hopefully they continue to head that direction. But in general, rates are going to be in the same ballpark. Then there's factors where every deal's different, right? Some banks use just a flat interest rate. Like if you're approved, this is what you're going to get. And then some banks use what's called risk rating, which is based on how much risk is involved in the deal. The interest rate will be, corresponding.
Appropriate, yeah.
Correct. And I think some of those factors that are going to influence that is doctor's personal financial statement, right?
Okay.
Stronger their personal financial statement, the less risk they are individually. Second would be the startup. If you have grandiose plans to do $1 million startup, you're going to pay a higher interest rate for that because that bank they're going way outside of the norm, and outside of the norm means there's more unknown variables. So you're going to pay a higher interest rate for that, but you're going to basically have a reward from that, right? If you're doing $1 million startup, you're probably equipping 8 operatories, right? 8 operatories. If you're collecting $250,000 a year out of 8 operatories, that's $2 million a year in revenue. If you're doing what the typical doctor is doing today, where they maybe have 3 operatories equipped, you're capping yourself somewhere around $750,000 in collections. So your ceiling over here is way different than if you're doing $1 million loan.
Right.
So everything comes at a cost, right? If I make $2 million a year and I paid 0.5% more in interest, the amount of money I made at the end of the day paid for that 0.5% interest rate over and over and over again. So there's a lot of variables on what will impact the interest rate.
Okay.
Loan sizes, we've talked about that a little bit, right?
Yep.
If we're talking about the startup world, again, the average right now is $750,000 to $800,000. If we're looking at acquisitions, typically the banks are going to say, hey, whatever the practice collected, that is the most we will lend, right? So if the office collected $1 million, the maximum loan size you're going to get is $1 million. Some lenders will cap that at 90%, maybe 85%. One thing that Provide does that's unique is DSOs, right? DSOs have come into the market for the last several years, and they're known to pay 3, 4, 5 times EBITDA, which sometimes can be 200% of collections.
Yep.
And what we've tried to do is continue, like we always have, to be there for the dentists. How can we help these individual dentists achieve their goals? So to try to give them an opportunity to compete with the DSOs, we can go to 120% of collections.
Oh, wow.
Right? So to give them a fighting chance to be able to acquire that office.
And hopefully that has an impact on the whole market and industry, like how you guys started giving people more money and everybody else followed suit. Hopefully it follows that way in the acquisition market as well.
That's right. Right. So going back to a topic we spoke about earlier, that 100% of collections, that's one of those things that were put in place and left in place, right? Why is it 100% of collections? Well, that's just the way it is, right? From strictly a financial standpoint, the argument is, well, okay, we have an office that is collecting $1 million, but it has a profit margin of 60%, which is fantastic, right? Yeah. Well, and then a bank says, well, we're only going to give you $1 million because it's collecting $1 million. If that same office were collecting $2 million and had that same $600,000 in profit margin, the bank would say, oh, it's collecting $2 million, so we can look to lend you up to $2 million, right? So that's where we've tried to use the logic and reason to stretch those borders and be able to give these doctors a chance to pay what is really, arguably fair market value based on how profitable a business is. Yeah. Because that's what is the profit of a business is really the most valuable part of it.
Yeah, totally. So the other part of the question is not just variables in the loan, but like you could call them variables, what makes you unique, your USPs. compared to the traditional banking, if I was sitting in front of your table right now, I'm not Harrison at Hip on a podcast. I'm shopping around lenders. What's the pitch? Why am I coming to Provide? I think we've all seen the benefits of working with like a fintech company over traditional banking, that you guys are not into the same box, but maybe pencil to paper. What are the big differentiators that really sell the product?
Starts with the technology, right? That technology is speed, how quickly we can move. Time is money, period. If you are looking to start a business or acquire a business, every day that goes by is money lost that you'll never be able to recoup. Opportunity cost is the economic term.
Right.
So if it takes you an extra 30 or 60 or 90 days to start to open your doors or to acquire that practice, well, that startup world, that's growth time, right? You're now 30, 60, 90 days behind growth, and you can never go back in time and recoup that. Acquisition world, you missed out on 30, 60, 90 days of owner comp, right? And if we're buying a healthy practice, that could be $100,000 of lost. I mean, it's all relative to the size of the practice you're buying, but it literally could be hundreds of thousands of dollars of lost income that you can't go back in time and get. So the technology allows us to, it's all electronic, right? There's no documents you print off, you sign, and you have to scan them in, and that headache, right?
Yeah.
Old school. And so you can literally go in, you can complete your application from your phone.
Wow.
Right? Obviously your computer or iPad, but you can literally do it from your phone. You can complete your application in, 30 to 45 minutes. And then the underwriting time frame, because of our technology and our people, which our people is kind of our second piece to add to this equation, our underwriting time frame today is 4 to 5 business days where we can have an approval.
Wow.
Super fast, weeks ahead of average.
Super fast.
And then closing time frame, again, startup, different beast than an acquisition. We can close on an acquisition in 3 to 4 weeks.
Wow.
Super fast, where you can't even a lot of times close on homes this quick.
Yeah,
right?
No kidding.
Startup world, you're of course building a business. You might be gutting a space, doing the tenant improvements and bringing the equipment in, and you're subject to the contractors getting their piece done, the county with their permitting.
Yeah.
So there's variables at play there that we cannot control, but that time frame, from our standpoint, we're able to move light years quicker than anybody else because of our technology. The second piece I tell doctors about is our people. Even though we're a relatively newer company, a bulk of the people that Provide has brought onto the team have over a decade of lending experience. So that's people like myself who are out here talking with the doctors, who are out here talking with people like you, and then our credit analysts who are the ones who are underwriting the deal, right? So when the analyst picks up Harrison's deal and says, okay, Harrison is asking to start an office, here's Harrison's personal financial statement, here's the space, here's the rent, here's how much they need for equipment, here's how much they need for tenant improvements. They've looked at a deal like that thousands and thousands of times.
And it's dental specific.
It's dental specific, correct. So that analyst is looking at it, whereas what can happen outside of the dental world is an analyst looks at it and they just got done looking at somebody who's asking to start a landscaping business, right? And the person before that wanted to start a gym, right? So they're kind of putting puzzle pieces together for the first time. So our credit analysts, the majority of them have an extensive background, great people. They want to get deals done. They're going to be reasonable. They're going to also mitigate risk, but they're looking at deals knowing that the dental world, right, the dental industry, owning a practice, wildly successful. Default rates in dental loans, the second or third lowest industry in the entire country.
Dell was saying something about that actually when he was here too.
Well, so like the number one is funeral homes, right? Funeral homes seem to never go out of business because we have longevity, right? But the dental world, owning a practice is one of the safest investments you can make. So then from our people, we go to our product offering, right? And we touched on our products on a few different levels, but the type of loans that we're able to put together, the things we're able to say yes to for doctors, we're second to none, right? We're continually stretching that space. And we've talked about acquisitions, we've talked about startups. What we haven't gotten into yet, and I know we're going to, is those doctors who do want to grow, right? Additional locations, whether you're starting an additional location from scratch or you're buying a location from a doctor who's ready to sell. Ground up construction where you need to buy land, you need to build, and then you need to equip that space. The type of loan offerings and products that we're able to put together, we've continued to lead the way.
Yeah.
Right. So on a very simple level, and we can go into whatever questions you have on this.
Let's get into established doctors that want to grow, because I think we have a lot of those people in our audience. I'll let you take it, but some of the things that you and your friend Jacob, who works the Atlanta area, Georgia area, that were telling me with, hey, there's no buildings available. I want to buy some dirt. Some of the things that you guys have told me you've been able to do are, incredible. So I don't want to steal the thunder on that, but let's talk about existing doctor or already an owner. I want to expand. I want to grow more locations. Let's talk acquisition. Let's talk expansion. Let's talk renovation. Let's talk buying dirt.
Okay. This is where the conversations get fun for me. Doing this for well over a decade, and I love helping that doctor for the first time. Even more exciting is watching a doctor go from one location to 2 to 3 to 4 to 5 and so on, because those happen on such a small level, right? And you may have a lot of doctors who say, yeah, I do want to be a multi-practice owner, and then they'll get their first office and they say, you know what, I kind of like my one office. My work-life balance is where I want it to be, and I just want to keep this office. And that's to each their own, right? Those doctors who are ready to move to 2 locations and 3 and 4 and 5, that becomes exciting because you don't get to work with those doctors a lot, right? So it's new, it's different. When we look at ground up construction, you have the land that you need to buy, which land is not cheap right now. You need ground up construction, the exterior walls and the interior walls, and then you need your equipment. And you may want to add additional square footage so that you can rent out some space, right? Lower that cost of doing business. We are able to finance all of that with 100% financing. And those projects aren't cheap, right? By the time you buy the land and you take care of the building, to get that all done for under $3 million, you're doing pretty good, right? So we're talking a big project to take on. We are able to do 100% financing, the land included, to where a doctor
land included.
So the doctor is able to hang on to all their cash, whether they want to keep it in the stock market so that they can keep on getting the stock market gains, not pull money out of the stock market so they don't get hit with the capital gains taxes. But to have that safety net, you're able to continue to keep all this wealth that you've accrued while continuing to build more wealth by taking on a building that historically they're going to appreciate over time. So now you're accruing another asset, right?
I haven't seen many people, if any, that'll finance that 100% with no cash out of pocket.
Yeah, it's pretty rare.
What's typical, like 20%?
20% cash injection. Sometimes you might have to buy the land cash first, and then the bank will say, hey, we'll take care of the rest.
But even if I was buying the land, I'm looking at 6 figures, high 6 figures, depending on the location, maybe more.
Possibly 7 figures.
That's what I'm saying.
Yep.
The right locations could be a 7-figure thing out of my pocket.
Right. So it takes a lot of people out of the game because they think that's the only option they have. And so that's kind of the education process, right? Is letting the market know, letting the dentist know, hey, you do have options here.
So long term too, if you're been in practice 2 years or 5 years or 10 years, kind of like we were talking on the startup, getting an associate gig, spending appropriately, saving appropriately is going to be a big impact on future financing. So now here we are 2, 5, 10 years in practice. Those same principles apply.
They sure do.
You know, if you're in an area where there isn't a lot of real estate for sale, and you're like, man, there's no real estate for sale, and I don't have 20% to go into a $3 to $4 to $5 million project. I guess I'll just stay in my one office. Yep. It sounds like you guys can make a big impact there.
That's exactly right.
Yeah.
Yep. You hit the nail on the head. And those principles they're always going to be there. And, you can plan, right? Or you can have a vision, and that vision can change. And sometimes something may come into play that you never even considered, right? So you could be a doctor who's owned an office for 5, 8, 10 years, and you never even thought about ground-up construction, right?
Yeah.
But now you're in a place where you've been looking for a building, and the only option is to buy land and do ground-up construction. So that's another area where Provide has really looked at the marketplace and said, we see a problem out there. We see a lack of inventory for people to buy commercial real estate buildings to be able to take that next step of ownership. How can we be there to answer? And that's where we rolled out this fantastic product where we're able to do 100% financing for ground-up construction, including the purchase of the land. And it's incredible. It is absolutely incredible.
Game changer. I can't do the math in my head, but let's say it's a $3.5 million project. I would be expecting to put 20% down. I'm looking at
$700,000,
$700K out of my pocket. Incredible.
And if you had that $700,000 to put down, that might be so much of your net cash that then the bank says, well, that's great that you can put that in.
I was just about to ask you.
But now you don't have enough cash left over for us to be comfortable giving you a $3 million loan.
I was just about to say, so I've got the cash to put into it, but then I can't get the rest of the loan because the rest of my personal financial statement doesn't look good enough.
Yeah. Can really be a double-sided sword.
Huge door opener.
It's been a fantastic product to have, and it's not for everyone, right? Again, these are the conversations that we have. We have to have some tough conversations about what makes sense. We're never going to put a doctor in a position where, hey, great, we just financed a $3 million building for you. You didn't put any money into it, but you're going to have trouble paying it back, right? We're always going to be running a financial analysis to make sure that your what we call debt service coverage ratio, which is a fancy way of saying after you pay all your bills, how much money do you have left over, right? There is a built-in margin that is a pretty conservative margin to make sure that we're not stretching you too thin.
Cool. So we've hit one end of the spectrum, startups, first-time practice owner. We just shot to the other end of the spectrum, established doctor, established owner, doing well, wants to do even better.
Yeah.
Let's talk about in the middle. I'm an owner. I have 1 or 2 locations. I don't really want to expand more, but I feel like there's something you might still be able to do for these people. Mm-hmm. Maybe I started my practice 5-10 years ago and I have a traditional SBA loan. Mm-hmm. Is that something? Renovation, equipment upgrades. I got surface level understanding of this, but I'm sure that middle guy who's doesn't want to expand, not a startup, but could use improvements here. What other types of products, solutions? Are these people a good fit to reach out to you? Let's talk on that guy, just improving what I've got kind of guy.
Yeah, 100%. There's a what we would call jumpstart offices is what we call them. And people will buy these as well. So this is also great for that doctor out there who may have went and looked at an office that's been in business for 50, 60 years, hasn't been updated for 40 years, right? And so you walk into it and you feel like you stepped back in 1980, right? A little bit of the you remember the yellow and the pink and the baby blue tiles that were in bathrooms. So, but you may be an owner who also has had that office and you're crushing it in those. There's people who have those offices that they haven't had to update them and they're crushing it. But you may get to the point where you say, okay, now's time to renovate. Yes, absolutely. You can get a loan to do a remodel. Very simple. Everything we've talked about today, 100% financing.
100% financing.
Everything we've talked about today. So
that's huge.
Right. So which is renovations, equipment. I think that if the doctor is in that position where all they want to do is a renovation, that's generally about as simple as it gets, because you probably have a practice that's doing well today. If it needs renovated, you probably don't have much debt, if any, maybe an equipment loan or two.
Sure.
And so your cash flow and your established position that you're in, you're probably in a point where, you might need a few $100,000 to do that, right? New floor, new paint, new lighting. If you're going to upgrade equipment, then you could tack on a couple $100,000 to that. But that is in my world, that is a very basic request.
Okay. What about I have a practice loan. Maybe I did like a traditional SBA or something like this. Do you ever do refinances for people? Yeah. What would be some, if I'm listening to this episode, what would maybe be some indicators that like a refinance might make sense? And candidly, maybe some indicators of like, honestly, there's no sense in refinancing unless you got a great situation.
Both of those, right there. So SBA, there's a multitude of reasons why you would refinance them. There's actually a gentleman I'm talking to right now. I just spoke to yesterday for the first time. He has an SBA loan that doesn't have a variable interest rate, and he got it at a very good interest rate. And that conversation parlayed more into the fact that he had a 5-year balloon, and that 5-year balloon was going to be due in about a year and a half. So he doesn't have a choice but to refinance. And if he were to refinance SBA rates have gone up a very, very high amount in the last few years. Whereas conventional financing, those rates have come down a good amount.
Okay.
So we're going to be looking to refinance him out of SBA into conventional. He's going to have an interest rate that's pretty similar to what he has today, but he has that balloon. And for folks who don't know what a balloon is, it means you might have had a 25-year loan, but the bank says, hey, after 5 years, it's due. So you get the monthly payment of 25 years, so you have a nice, small, affordable payment, but you need to pay us off in full after 5 years. So on the flip side of that, SBA loans traditionally are a lot higher than conventional financing. And SBA loans, for the most part, are also variable loans. So you may have done an SBA loan that was prime plus 2% back when prime was 3%.
Yeah.
Prime today is 8.5%. So if you're prime plus 2, your rate has climbed to 10.5%, right? Which that's a large interest rate.
That's big.
So those doctors would want to refinance with us so that they can get out of paying 10.5% and come down, half of that, maybe more, whatever the number shakes out to be.
Yeah.
Another reason where a doctor may say, hey, I actually have a lower interest rate today, but I'd rather pay a higher interest rate because I want to consolidate my debt.
Oh, interesting.
Right. So you may have debt on a short term, and you say, hey, my monthly payment is huge because I have to pay this off in 7 years. And so we do a refinance and recast that debt, consolidate everything, and you may free up $2,000, $3,000, $4,000, $5,000 a month of debt service coverage that you're paying. So cash flow purposes.
You're right. Awesome. So last thing top of mind for me, and hopefully, maybe we get into some other mazes, but probably the biggest obstacle we run into with first-time owners, they get strapped for cash way too early. A lot of times they find us too late, and either a marketing plan, marketing budget wasn't thought about, or it wasn't part of their business plan when they were getting into financing, or when they got financed, they didn't get enough money for marketing. And so now they've spent their whole loan on chairs and equipment and build out, et cetera, and they come to us and they go, ready to open my doors and I got 10 grand to market my business. Yeah. And we're like, you're in Austin, Texas, or you're in Los Angeles. How are you taking a new business to market with 10K? And they're like, well, this is what I got.
This is what I have.
This is what I got. So I don't want to steal the thunder here, but this was probably the biggest thing that you and Jacob shared with us about how you're able to get creative in structuring their loans and working capital to make sure they're set up with a runway. This is where I see these startups get just strangled, is they don't have a runway, let alone for marketing, let alone for proper team, let alone for the other things they need to actually get the business profitable. They got enough money to buy stuff and open doors, and it's done. Yep. So how do you guys get creative on that? I'd love to hear you talk on that a little bit.
So you hit the nail on the head, and it's you probably see it even more than I do because of the amount of doctors who come to you after the fact,
right?
But basically, they get to a point where they've spent their money, and now they don't have money for marketing and advertising,
and team and consulting and
everything.
All the things they need to actually get this business off the ground and profitable. Not just I've got lights on and my doors are open.
Yeah. So the very short answer to that is us being able to carve out money for you, for the consultant, for the advertising, for the marketing.
So you can just carve that in right into their loan.
Correct. And so the doctor is always going to need money for tenant improvements. They're always going to need money for equipment. And they're always going to need working capital. And what gets left out far too often is money for consulting, marketing, advertising, or as you put it, the money to grow the business, to bring the patients in, right? Yeah. How are you going to get them there? And so having that money carved out, there's a couple of ways we can get there, right? So as we've talked about multiple times, at the end of the day, the numbers need to make sense, right? There's a reason why not every doctor is getting $1 million startup loan.
Right.
We're not going to put a doctor in a position where they're going to struggle to pay. So some doctors will automatically, based on their past experience, history as a doctor, their personal financial statement, the space that they found, how much is that lease going to be? How large is the space, right? How much square footage do we need to build out? If you're trying to build out a 3,000 square foot space and it's, contractors, ballpark, depending on the part of the country, it's going to vary and fluctuate, $200 a square foot to build out a space, right? So you're going to need $600,000 just to build that space out. Now, the landlord, if you work with somebody like Dell from Carr, who you did the podcast with previously, they're going to work to negotiate with the landlord to get tenant improvement allowance, which is the tenant or the landlord giving you, the tenant, money to help build that space out. So that's going to reduce the amount of money you need from the bank, but we're still eating up cash. And the more cash we use, the higher your monthly loan payment is going to be with us. So in those instances where it starts to get tough, and this is another area where Provide has been absolutely phenomenal with helping practices grow. Yes, would it be amazing to have 4 chairs the day you open your doors? Of course. Then you don't need to buy them in 6 months or 12 months or 18 months.
Right.
But if we peel back, we've done this, and we where a doctor does fewer chairs today, and Provide will look at it and say, "Hey, doc, well, in 6 months you filled out your 3 chairs. You're on pace to collect $1 million in your first year. That's phenomenal,
right?
Like, you're doing everything we could ever ask of you, and you're building cash, right? So you're doing those financially responsible things that we've talked about previously. Doc, you need another $75,000 to put in 2 more chairs. You need another $100,000. I have a very successful doctor in Tallahassee who we did this with recently. We gave him another $250,000 within 9 months so that he could fill out the rest of his office. That is not normal. Typically what a bank is going to do is say, we just gave you money. You need 2 years of a track record before we'll even consider giving you more.
Oh, I see.
Right. So we can put this puzzle together in multiple ways. I would love to give the doctor the 4 chairs up front and give money for the consulting. But if that number is tight, we can still figure out more ways to get this done for the doctor, right? So it's not if this works, great, doc. But if plan A doesn't work, then we're not going to be able to do it. We have other avenues we can go to or go down. So this is a big reason why I joined Provide, is our ability to think outside of the box, deliver and give the doctors what they need, and provide more solutions Sometimes there's not a solution today, right? But to be able to offer as many solutions as possible. So in an ideal scenario, to answer your question, Harrison, directly, we would prefer to give them that full ask up front, right? The money for the tenant improvements, the equipment, the working capital, and the consultant. If we need to peel back on something so that we still make sure we have money there for the consultant, because it doesn't do you any good to have 4 chairs if you don't have any patients, right? Right. So there's multiple solutions.
That's awesome. I actually hadn't heard of that if they're doing great, you'll come back to them and offer them more money.
That is not normal.
Yeah.
That is not normal.
That's totally new to me. That's awesome.
Well, I'm glad.
Yeah.
We have more to share.
Yeah. Well, those are kind of my hot button talking points. I have a feeling you and I could probably talk in here for hours on end.
Of course. Yeah.
But I think there's a tremendous amount of value to the audience. So I want to make sure we cross all the T's, dot all the I's. Any other big topics, subjects, things to think about, flaws to look out for, anything as broad or specific as you'd see fit that you think might be valuable to the audience for today?
Yep. Great way to end it. I think that having the proper people around you is key, right? If you're looking to do a startup, you need to make sure that you have the people in place, right? So you're going to need a space finder to help find the right space. You're going to need that space finder to help negotiate the lease. You're going to need an equipment rep, supply rep. You're going to need a CPA. You're going to need an attorney. You're going to need a lender. You're going to need the consultant, the marketing, the advertising. You're going to need the IT guy, right? You don't need to try to figure this all out on your own. This is don't reinvent the wheel. Right.
Yeah.
This is something that has been done over and over and over again, all day, every day, across the country for decades now. And that's why that's what the dental world has, this community built around it because of how successful it is, right? HIP is doing what HIP is doing because how successful the dental world is.
Right.
Right.
True.
So if you're a dentist, whether you are just now for the first time thinking of starting an office or buying an office, the first thing to do is start to get plugged into or plugging in with people who do this all day, every day, so that you're getting that valuable feedback, that valuable advice, that guidance, being consultative, working with people who are consultative, right? People who are going to give you information that you need, opposed to someone saying, let me know when you, in my world, it'd be, when you're ready, give me an application. We'll take it. We'll submit it to credit. And if we get an approval, we'll talk about the next steps then.
Yeah. I mean, Dell said the same things on our episode with Carr. We say the same things. You guys say the same things. And I think it's more than a coincidence that we've all become friendly together. But you make a good point. I've been at HIP now over 5 years. Company's been around for a decade. To my knowledge, we've never really made a relationship with a lending team, and I think part of it is you guys take a similar philosophy to us. It's not just when can I get my contract to you? It's how can I be a guide? How can I be a resource? How can I be somebody or something that you can lean on? Between the knowledge that we have, the people that we have, the Rolodex that we have. And I've felt that commonality from you and Jacob and from Dell and Keith, and obviously that's how we operate. But you said that. You're like, most lenders, it's like, all right, let me know when you want an app. Yeah. I think most marketing and consulting agencies probably say the same thing. Let me know when you're ready to get started. And if you told me 5 years ago that we'd be building relationships with the lending guys, I would have said no way. But I think it's a great partnership. Yeah.
The synchronicity of it, it's just naturally there.
Totally.
And we are all working towards the same goal. Doctor wants to be successful. We want to help him get there.
Bingo. Yeah. Anything else you want to share?
It's great time.
Before we break, if anybody watching wants to get in contact with Provide, obviously I'm sure they could go to the website, but people like people. There's the old saying, people don't buy products, they buy people. And I think you've given a lot of insight and value today. If somebody wanted to reach out to you directly? What's the best way?
My email is nice and simple, John, Jon, at getprovide.com. My business cell phone number is area code 614-787-5877. Always open to talk. There's doctors I've worked with for 5 years before they bought a practice or did anything, and hundreds of conversations. So I'm an open book. That consultative part, that's probably one of my biggest pleasures of the job.
Awesome.
Right? Being able to talk to a doctor and having that doctor say, wow, I've learned so much from this phone call. Right, like I have such a more clear picture of what I need to do and where I go from here. That's, to me, that's the biggest compliment you can get.
Yeah, feel the same way. But since you're local here in Florida, though, obviously we've got listeners all over the country. Mm-hmm. They can reach out to you directly, and you could point them to the person in their area.
That's exactly right. Yep.
Okay.
So yes, if you're in another part of the country, reach out to me. I will plug you in with your local rep, and you'll get that same level of experience and expertise with anybody on my team.
Rock on. Well, it was really good having you on the show, man.
It was great being here.